Example 4 of Regulation 1.1032-3E deals with a parent company issuing its own stock to compensate an employee of a subsidiary of the parent. In the example, Corp X owns all the stock of Corp Y. B, an individual, is an employee of Y. Pursuant to an agreement between X and Y to compensate B for services provided to Y, X transfers to B 10 shares of X stock with a fair market value of $100. Under Regulation 1.83-6D, the transfer of X stock by X to B would be considered as a contribution of the X stock to the capital of Y, and immediately thereafter, a transfer of the X stock by Y to B. If there were no special rules in the Section 1032 regulations, the basis of the X stock in the hands of Y would be 0, and Y would recognize gain when it is deemed to transfer the X stock to B. Fortunately, the 1032 regulations contain a special rule that avoids this gain recognition. Under this special rule, X is deemed to first contribute cash to Y, then Y is deemed to transfer the cash to X in exchange for the X stock. Since Y is deemed to have purchased the X stock for $100 of cash, Y has a $100 basis in the X stock. When Y transfers the X stock to B, no gain or loss is recognized by Y. If Y is a foreign subsidiary of X, the deemed contribution of the $100 from X to Y must be reported on Form 926, and it would be necessary to review the tax rules in the foreign country to see how this type of transaction is treated under the laws of the foreign country.